At the tender age of 10, Peter Lynch's father died of cancer, which forced his mother to take a job at a local manufacturing company. To try and help out, Peter got a part-time job as a caddy at a prestigious country club, where he met some of Boston's most successful business leaders, one of whom, who according to Peter was a hapless golfer, but a great guy and a good tipper, according to his scoring system at the time, who was an executive at Fidelity Investments. After graduating from Boston College and then Wharton, Mr. Lynch went to work at Fidelity, where he would go on to become one of the greatest stock market investors of all time. In fact, if you had invested $10,000 in the Fidelity Magellan Fund in 1977 and held on through 1990 when Mr. Lynch retired, your investment would have been worth nearly $280,000. Talk about the power of compound interest. But shockingly, when Mr. Lynch got around to writing a book, he did not recommend that most people start by investing in stocks. Hi, I'm Todd. In my early 40s, I retired from a successful career in investment banking to focus on my family and my love of investing. And within a short period of time, and based entirely on my own research, I made more money investing than I had saved during 20 years of working at the day job, which allowed me to devote myself to deeply held interest in economic history and writing, and led to my first book, which was published last year. These podcasts and my free Substack newsletter are my way of helping to communicate some of the things that I've learned along the way. Let's take a very short break, and then we'll come back to learn more about what Peter Lynch recommended as the best investment for most people to start off with. When, as a young real estate investment banker, I was teaching myself how to invest in stocks and learned that Peter Lynch was about to publish a book on the subject, I couldn't wait to get my hands on a copy. You can only imagine my surprise when, after eagerly cracking the cover of One Up on Wall Street, I came across the following advice from one of the greatest stock pickers of all time. Quote, "Before you do invest anything in stocks, you ought to consider buying a house, since a house, after all, is the one good investment that almost everyone manages to make." End of quote. I mean, wow. Even Peter Lynch thought buying a home was the best way for most investors to get started. And looking back now, it's also remarkable that Mr. Lynch's advice implicitly assumed almost everyone starting out in life would be able to afford a home. And at the time, this advice was not only sound, it also reflected nearly a century of experience for most homeowners in this country. Clearly, the housing markets have dramatically changed since Mr. Lynch published One Up on Wall Street in 1987. In fact, just 2 decades later, the worst housing bubble in our nation's history started to collapse, causing some 4 million families to lose their homes to foreclosure. And now, less than 2 decades after the bubble, we have an unprecedented affordability crisis, which helped Donald Trump win re-election last year and, ironically, has also helped the socialists take the lead in New York's mayoral contest. Furthermore, just this week, the Wall Street Journal ran an article about how more and more people are losing faith in the American dream, in large part because of this affordability issue, especially for people starting out in life. Referring to a Texan named Jeff Lindley and his family, the Wall Street Journal article noted, quote, "They bought a house and later built 2 more. Now, though, 2 of his 3 adult children live with him in Godley, Texas, on the property, 1 in a trailer on the property, and 1 with her husband and child in the home." Now, whenever a market like housing that previously functioned so smoothly for so long starts to behave so differently, we have to ask ourselves a series of questions. First, how did this market work historically before it started to dysfunction? Second, when did things begin to change, and did that change come on suddenly or gradually? Third, what changes occurred that were of sufficient magnitude to re-alter the dynamics of something as enormous as the national housing market? And in addition, how does all of this affect the prospects for housing and homeowners going forward in this new environment? Let's take another very short break and then come back and look at the three key periods in our nation's housing markets. So, to summarize, our housing markets have gone through three major periods. First, we might call it the get-rich-slow period. For nearly a century, housing was not only the foundation of the American dream, it was also thought of as a way to get rich slow. You started work and a career, bought a home financed with a long-term fixed-rate mortgage, and as the home gradually appreciated and you slowly paid down the loan, the value of your equity investment in the home grew and grew and grew. This was the history that led Peter Lynch to recommend that people buy a home before they start investing in the stock market. The second period was the housing bubble. After this century of relatively steady performance, in the late 1990s, about a decade after Mr. Lynch wrote his advice, housing prices suddenly started to appreciate much more rapidly than at any time in history. As this rapid appreciation picked up in the early 2000s, millions were lured into this idea that a can't-miss investment had also become something of a rocket ship to sudden wealth. But then in 2007, what had become the biggest housing bubble in the nation's history began to collapse. Home prices plummeted, millions who had been lured in lost their homes and their savings, and for those working in the housing industry, they also lost their jobs. And then the third phase is the affordability crisis that we're dealing with now. For a few years after the bubble, home prices continued to collapse back down towards historical levels. But then, almost magically, or so it seemed, in the mid-2010s, home prices started rising rapidly again, well above the historic rates from the prior century, or the century preceding the bubble. After a number of years where home price increases were similar to those in the early stages of the bubble, prices finally started to decelerate a little bit in the late 2010s. But then beginning in 2020, they started skyrocketing again. But clearly something was wrong, because even as real wages or real incomes, which are wages minus inflation, were stagnating, real housing prices were soaring. In short, an affordability crisis was in the making, one that hit first-time homebuyers especially hard. If you already owned a home and could effectively trade it in for a new one, well, that was okay. But if you were young and trying to save enough to buy a home out of your earnings, well, tough luck. This is where we are today. Now, in future episodes, we'll look more closely at how the housing markets worked when they were functioning smoothly, the changes that led to the bubble, how we evolved from the bubble's collapse into the current affordability crisis, and what all of this means for current and aspiring homeowners. Now, today, we face important challenges, like the housing affordability crisis. But none of these are greater than the issues we have overcome time and time again throughout our storied history. Here's to hoping your day is as bright as America's future. I'm Todd, and thanks for your interest. If you found this helpful, please subscribe and recommend it to at least one other person. If you'd like to learn more and to find links to my free On Wealth and Progress newsletter and my book, please visit my website, toddsheetswriter.com. Thanks again.